Hi, students. One of the has to come in the exam, whether paper one MCQ or paper two, the practical questions in the exams, accounting ratios. So I will tackle accounting ratios because there's lots of questions coming up on that. So I'll take one per day, every session. So the first one is debt to equity ratio. Most of my students says we cannot memorize it. We will forget it. When they ask you for debt to equity ratio, there are two things in the wording. Debt, which is on top, which we replace it by non-current liabilities, which comes from the statement of financial position. And the bottom part will be the equity part. And the equity comes from the statement of financial positions under equity times 100. Basically, anything above 50%, it's considered to be a high ratio, okay? Which considered means that the company is more dependent on debt. So the interpretation, which I want you to write in the exam, if the ratio shows more than 50%, you write it's a high ratio. You say this, the number one, you say this, debt to equity ratio of 50% or above means the business use whatever debt percentage you've got for debt for every dollar of equity, indicating high gearing, greater financial risk. They are interested, if it's below 50%, you will write low, and you do low ratio means it relies more on the equity, not on the debt, which is generally safer. What I want you as well to know, the tips which we need to have. So always mention the level of risk. So whatever you got, so 50%, we write for every 50 cents in debt, we have dollar in equity. Okay, so we mentioned the level of risk. If it's above 50, we will say it's a high risk, high financial risk, mainly depending on debt. If it's below 50%, mainly depending on equity. If it's above 50%, we say that it will be harder for the business to meet their long-term obligation. If it's below, we say the business meet its long-term obligation, okay? As well, for you to get better marks as well, you can say one of those things or two of those things, okay? One of them, there is no explanation of the cause. Why are we depending on equity, or why are we depending on debt? So mention that to them to make sure that the examiner understands that you understand, okay? If there is no comparative or comparing industry average, say, I cannot compare it to anything because I don't have another year average. I don't have a competitor. I don't have the industry average. So that's one, okay? For the gearing, always say the payment terms. We don't know about the payment terms, so I need more information. That should explain debt to equity, okay? Let me know in the comments if you need any further queries about this debt to equity. Thank you very much. See you in another accounting ratio.